Morning traders, welcome to the Traders Lab. I'm your host Tom B. Thanks for visiting the lab today. It is Monday, March 9th, 2026, 10:30 a.m. Central Standard Time here in Chicago, and I appreciate you all stopping by. Reminder, in the States, morning traders, welcome to the Traders Lab. I'm your host Tom B. Thanks for visiting the lab today. It is Monday, March 9th, 2026, 10:30 a.m. Central Standard Time here in Reminder, daylight savings time started in many areas of the United States. Be sure that everything is adjusted correctly if that has impacted you. Depending on the software product you use, some of the things in there may not adjust. So just be sure to check everything. Hold on one second. General disclosure, all Bookmap Ltd materials, information, and presentations are for educational purposes only and should not be considered specific investment advice or recommendations. Risk disclosure, trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please remember this isn't a trade calling room. If we get into real time, we'll talk about it. Also, this is about the business of trading. The idea of Trader Lab is to help traders build consistency, understand this is the business of edge, trade plan, and discipline. Doesn't matter what you do, how you do it. What does matter is you know what you're going to do before it shows up. And then the idea of having a plan is to align with the current condition of the market in your time frame. Now, of course, what is the time frame and what is the condition of the market? It's really in the eye of the beholder. But what I will say is that most developing traders, and this is just what I've observed over 47 years of trading and a fair number of years also helping other traders develop and coaching and the rest of it, is that you need to isolate a dominant side, develop a plan to align with that side because of how that impacts your edge. And that is that if you can't trade from a dominant side, you won't be trading from the other side. So this is a sequential process of learning and education. And you do need to know what the dominant side is, what trades that you've identified have a statistical edge that favors you. Also, that includes getting risk neutral, trade management, exits, and the rest of it. All of that is process oriented. So not to wear out this reminder to everyone, I think it's pretty obvious that if you can't trade with a dominant side and identify the side and then know when things change based on the conditional statements you use in the process, you're going to be either fading a dominant side or but the idea is this is not a business of flip-flopping. It is a business of alignment. So based on how you define the condition will tell you either to stay in alignment with the dominant side, or when the condition changes based on your definition of dominance, then either you have no further trades in that direction or you change. But I look at that as a sequential step beyond initial alignment. And I always want to come back to the original idea. If you can't trade with the dominant side, you won't sustain yourself in the business. My objective is not to teach gambling. My objective is to teach sustainability. So you have a chance to develop further. If you can't discipline yourself, you will go out of business. And that's just statistically based, like everything else in this business. So anyway, I hope that resonates with you. And of course, ultimately, you're responsible for your outcome, right? So this is the hierarchy that I use. It's basically a trading process. It's how the market works, which is rotations, what's too high, what's too low in all time frames. Volume profile allows us to see the distribution of volume in different time frames. Time frame is actually where you trade. Different traders trade different time frames, different rotations. It's very important to know the difference. The context is specific to the time frame you trade. And the way I think a time frame is a vertical integration. So it's not one rigid idea. It is trading rotations inside of each other. And there are specific behaviors we can anticipate based on the time frame and how we organize it. That's again up to you. And then order flow, well, we use Bookmap to see, you might say, where the rubber meets the road. By the way, the structured trades I share here, some of them at least, there's 60 PDFs of structured trades. These are available to everyone at no cost, as well as the Bookmap Discord Trader Lab community, where you could get some ideas on what I do and what others have done. And the Trader Lab is a community of like-minded traders who come together to leverage their collective experience. It's not about, right, wrong, or any of that. It's, can you build out an understanding of the business and then develop the discipline? These are some ideas for you to reverse engineer, and I'm going to disappoint all of you. There is no plug and play in trading. Don't we all wish? It doesn't exist. You actually have to learn how to trade, not imitate. And I know we all want the one thing that, sure, we want it. That's emotional. The business doesn't work that way. So if you want to learn the business of trading, you might get some help in the Trader Lab, and of course you have to do the work. And past performance is never indicative of future results. Trading is not for everybody, and it's going to require more than you can imagine, because you're going to be pushing back against primal wiring, and the primal wiring is always looking for certainty, but what happens if you're in a business where it doesn't exist? This is the higher time frame, and I am discussing higher time frame in relation to RTH candles, so only RTH. And this is Friday, a week ago Friday. I think I got that right, because this is Monday. So this is Friday. We had the news of the war starting, right? Gap low, squeeze. Now this is what's important. I want to show you a level, because everything I'm discussing here in the stream is based on something called auction market theory. And auction market theory is time frame specific. This level here, let's look at what this says. In here, the price that was too high was here. This is resistance. This is support. Again, as I define my time frames, everybody slices and dices the market into behavior that they can relate to. This is my interpretation. Others do it differently. There is no right way. There's only something that makes sense to you. So swing high, swing low. I use swings for volume, because that's where participants found too low and too high in here. So this was the last swing high, last swing low. The high volume in here, where most of the transactions took place, was here. So I look at this like the fair price in an intermediate time frame. So where that becomes support, think of this like shopping. This is that auction market theory idea. This is support. Now let's look what happens here. Market comes down. Remember what was too low? Oh, it's on sale. Off we go. New all-time high, by the way. We rotate down. Where do we come? Support. Where do we come? Support. Is everybody with me? Now we have the war. Where do we come? And here we're above support. Here we gap under, and it looks like the end of the planet, just so you know. And then we come back inside this level. This suggests what? Watch this. This is auction market theory. Where was the last place? It was too high. It's here. What's over here? The last place, it was too low. So I have too high, too low. Out here, come back in. Oh, we found excess. See you later. Now what? Let's go back and check what was too high. I'm not paying that. Shopping. I'm out of here. Then what happens? I believe this is Wednesday. ETH tests up here. I'm not paying that. And then we get our sellers. Okay? Now right here, we're still inside of this key location at 90. Now, what happens here? We open lower. We come down. We test where the stops are. So the buyers in here get thrown under the bus. And where do we close? We close under here. After coming across, so we get our stops out here, This is Friday's low, I believe, or Thursday's low. Can't remember. Thursday's low, I think. Losing my mind. I don't know what. You know what? Hold on. Let me just make sure I got everything right. Yeah, this is right. And then we fill the gap, but we can't come inside. And we close, and this is the key piece for me, under here. So this is too high, too high. Previous support, too high. For me, the context is down, which means primarily shorts until it isn't. Now what? Now let's come to today. Where's our outside edge here? 46.25. So we have a gap. This is today. We have support at 46.25, a location. Let me show you what I'm showing you. If this level up here is too high, outside edge, retail, outside edge, and high volume. So here's what I've got. I've got this, which is a big deal. If I come up in here, I can come up to 29 or wherever. I'm going to show you one other little thing and then we'll move on. This here is a retail price from the last time we were down here. It's called a naked volume point of control. It is at whatever this is, looks like 97.75-ish. So if we open in a gap, the idea of this is to sell because the trend is down and continue. So all short trades until the condition changes. And then we have potential targets here and we have one down here. It doesn't have to get there, probably never, or not today at least. And then here's the other piece, and this is really important. Market mechanics, and this is something most traders just don't keep in mind. One moment. So here's what we have. What we have here is, one moment again. Market goes up to go down. Market goes down to go up. This is market mechanics, and I did a webinar or stream on this on Friday. It really talks about one of the most important concepts for traders. Now, the thing to understand here is that the dominant side, and you have to vet this, is where most of the opportunity is because you're trading with the higher time frame. When you run out, then the traders who are short can get squeezed, and that's market mechanics, and they can become buyers. Now, in Trader Lab, what I always suggest to developing traders is you align with the dominant side and then learn to manage your trades and also define change. So if something changes and you're a developing trader who's not yet consistent or profitable, the objective then is to be able to recognize the change and always be deploying trade management. And if you have trade management, you will be taken out of your trades. That's the goal, is to keep some of your or most of what your open trade equity is, your MFE, maximum favorable excursion, and you will get taken out. Now, the thing about change, this is not a business of prediction, this is a business of alignment. So you always have to define in your time frame what change is. Now, change doesn't mean you turn around. It does mean, though, the trades that you were taking that were in alignment with the current time frame are no longer qualified. So when time frame changes, which you won't know until hindsight, you would already be taken out of your trades on trade management. But then as there's further development in a higher time frame, you would then define change. Then that change either gives you the following things. If now the change suggests different alignment and you have trades that are qualified, you take those trades. If you're not profitable and consistent in your execution before it changes, when you already know the dominant side, then you have no business trading counter trend until you can trade with the trend, and then stay aside when it moves against you. My opinion, my experience, up to you. You are ultimately responsible for your outcome. So I can only share what I know, and what I know is based on experience, nothing more. So let's go take a look at, so here's what we have. We have 46.25 We have the gap here, and we have key resistance is all the way up here. Unless we get back above here, this is just counter rotation and short squeeze. Now, if we can come back above this, I would have a different thought about it. But so for me, I primarily trade, at least what I discuss in TraderLab, is the short side only. Now, the long side, there are trades that have shown up. We can talk about those, but initially, I want to focus on the dominant side. And remember, if you can't identify and trade the dominant side, you're going to be challenged. So let's go take a look at Bookmap and how this all fits together. Is everybody with me so far? How are we doing in YouTube? Everybody there? Everybody conscious and TraderLab? Okay, so this is the RTH open. Now, we are opening in a gap, if anybody had forgotten, and we have some fundamental inputs. You know, there's a war going on and a lot of other stuff. Also, what actually happened, do you think, on Friday? What happens over the weekend? If the market is short, and the market was short on Friday, we hit a primary target, the previous day's low, and we got our short covering. What happens on Friday? Flattening out, evening up. Who knows, right? So those who covered on Friday, then what might happen on Monday? Well, continuation selling. If you got out on Friday, might you get back in on Monday if you're a day trader? Just things to think about. And then the market is short. That means shorts that are holding positions in here, and then new shorts that come in this morning. And in TraderLab, we understand that at some point when the market gets out of balance, in other words, by out of balance, the inventory is lopsided. That inventory, if we run out of sellers, think of it this way, we can get buyers. Who are the buyers? Buy stops, current shorts covering, and there's another piece. The ETH, what was that? Short. So what you have is shorts hanging out from Friday. You have shorts that covered from Friday. You get initiative continuation sellers this morning, and you have continuation sellers from the ETH also. So you have new sellers today, sellers from the ETH, previous sellers from Friday and Thursday and any other days, and then the sellers today. So you have short, short, short. And then what happens if we get too short? We can squeeze. Okay, so we know that. Now let's look at the first trades. Now these are structured trades. They're never trade recommendations. You must vet them. And you must also build out a trade plan, which is the purpose of TraderLab, is to help you build a plan. Now, what is this plan thing all about? It's that you know what you will do before it shows up. In other words, this is not a business, this is not a video game. It's really a business of anticipation. It's like the Heinz ketchup commercial. Anticipation. You are ahead of the market. You're not predicting the market. So by being ahead of the market means you know the condition of the market. You know coming in the market is short, but you also know that the trend is down. So knowing all the things we know about who's in the market, what the condition of the market is, that's called context, and the potential for a squeeze, what you need to do is come in with your plan, take your trades, follow your plan, and then that's the end of it. It starts and stops with your plan. So I'm going to show you structured trades. You have to vet these for yourself. There's nothing mechanical. Let me show you the trades. So if you were in TraderLab, the morning I would say was rather productive and profitable if you have vetted your trades. And here's the other thing about vetting. When you don't have vetting, you have emotions. You can't get over emotions or control over emotions unless you have something tangible. This is where the vetting comes. The vetting is saying, well, I don't know what's going to happen. By the way, none of us know. So that's a given. I don't know what's going to happen, but I know when this situation shows up, based on the research I've done, that I have a positive expectancy to at least get risk neutral before taking a full stop. How does that help you? Well, because now instead of thrashing with uncertainty, which by the way, we all have, except we both have, let's assume there you have a plan that's vetted and then you have no plan, you're just looking at things you've seen before and you don't know. You don't know if it has an edge or you don't know anything. You just say, well, this looks like a short. Which trader do you think is going to be able to execute and potentially build a business versus a trader that's making it up as they go, responding to emotion and playing a video game? Which one do you think can build sustainability? I think the answer is pretty obvious. Ask yourself which one are you? That's where you have to start. Which are you? A gambler playing a video game, or are you learning the business of trading and building out trades that might, underline, might give you an edge? So let's take a look. This is the RTH Open. It's 8:30 Central Time. It's right here. So what do we see? Now there's another thing to think about. If you were short from Friday or any other day and you get this gap on a Monday morning, what would you do? So here's the possibilities. If I go to my context grid sheet, here's what I know. Let's go back to the top of the stream if you missed this. I know the market's short. I know I have a huge gap. I know the ETH is short, the inventory, and I'm opening down in a sharp gap. What does that suggest to me? I might get buyers, and that's called responsive buying. Responders are someone, it's like you going to the store and your can of tuna is at 10 cents. You're going to respond and throw 10 in the cart because you are already short and now you see a gift. So you might take some off the table, some profit taking or whatever you're going to do. Now the traders who are not short are going to use any counter rotation, assuming the trend is down, which is my assumption, to get short for continuation trades. Remember, what do we have? Shorts in the ETH, shorts from last week, and potential short covering initially, and if that's weak, just some minor counter rotation, we want to sell it. That's where it starts. Let's see now how it plays out. This is the RTH Open. Remember the locations of, here's the RTH Open right here, actually. It's right there. So what do I see? My buyers. Now I'm going, oh, this is great. You know, there's my buyers. So I see my responders, and now I have to wait for a short. Let's see the first short. And again, you have to vet these for yourself. So I'm looking at this. Now, this is the first thing. Now, I've shared these ideas in TraderLab. Everything is not mechanical. And I understand when we learn, you know, when you learn, it is mechanical. Except trading is not mechanical. So you have to teach yourself to anticipate behavior. So you're going to take screenshots, annotate, watch the streams. You're going to do all that. Go to the library of webinars and TraderLab, and over, you're going to see me do the same thing. What I am not doing, though, is being mechanical. I'm aligning different pieces. I know the trend is down in my time frame. If the trend is down, long is not on the menu for me. My primary trades are going to be shorts. So let's see. So this is called VPOC migration. I'm going to label it. And it's a concept I made up for myself. I can't even tell you how long ago. In the 1980s. But different. You know, it evolved over the years as the tools improved. But I was doing this a long time ago. And the way I came up with this was, what does it mean? Well, you know, it's a line on a chart. What does it mean? This is measuring the volume. And when the market opens, it starts at zero. And this is called developing volume point of control. All it is shopping. So go back to the supermarket. What do they have? A retail price. Have you ever thought if the price is too low and the buyers are here, the responders, and now I have more volume here? What does it mean? Let's go to the store. Too low. What's this? The new retail price. Who are the buyers? Well, are we in a bull market? I couldn't tell you. I can tell you in the time frame I trade, I'm not in a bull market. So I'm only looking at shorts primarily. VPOC migration. Price is going up, Tom. What does that mean? It means wait. Okay. What's it going to do? I don't know. What do you think it's going to do? I think it's going to go down. Do you have a short? No. Where's the liquidity? Here. This is the retail price from the last time. Well, actually, hold on. 98. This is a naked volume point of control. Was support previously. It is now resistance. Neither here nor there. Let's just see what we get. So I'm looking for shorts. I have no idea. Here's resting liquidity. Going to the moon. Wow, look at that buying. Very impressive. Watch. Right here, I have resting liquidity. I have my buyers here. I have my iceberg selling here. I've got this. So right here, I'm looking at this area as for a short. Right here is my first suggestion because I have resting liquidity. Here I had liquidity. Nothing, no big deal. No big deal. No longs. Going higher, looking for the short. This is where right here. So right here, I'm looking at this, and I have my resistance. I have absorption. Now I have absorption here, right? What's the difference? Well, I don't have a trigger here. So, boom, retail price. If it breaks under here, can't get up, I would sell it. It holds. Now this is support. It goes higher. Now I'm looking higher. Don't know. Liquidity is here. I see, so I have my sellers here and here. So right here is liquidity. I've got my buyers. I pull back. I'm looking for a trigger. It goes higher. I've got nothing. Break down. This is a trigger. Here's my short. So right here is my short, and my stop goes here. For me, you, whatever you think. Watch. VPOC migration. Now I'm showing you another entry. Watch. Let's talk about the language of the market. Okay. By the way, if you have questions, drop them. I'll try to get back to you on them. This is the new retail price. Let me show you. So what I'm doing with this yellow line, it's just volume. There's nothing fancy about this. All it's telling me right here is this is the retail price. Look at the behavior. If this is too low, I go up. I'm going wherever. I break here. Now right here, so for me, and this is aggressive, is a short. Stop there. Break low. This is called VPOC migration. Now here's the possibilities. Of course, that or break low. If I break low, this becomes resistance. Let's just see now what happens. This is a short. This is a trigger, and it's called VPOC migration. Made it up. It's right there. That's a short. Break low. Now I can sell here. I can sell here. My stop's got to be out here. Let's go a little further. So anyway, these are all shorts in TraderLab, Now there's another one here, but this one's a little more advanced, and I would actually say a bit more difficult, but let's look at it. I use the variable high volume nodes, right? Yes. And I use them because what I'm doing is all I'm doing is not complicated. It's actually simple. And I believe complexity is not the answer. It's really more stripping this down to its most fundamental elements so you can minimize conflict. Let's look here. I'm going to show you. So this, of course, is more advanced. This is structured. That's a short. This is a short. This is a short. This is a short. That's a short. Same concept. Too high. See it? All these are TraderLab structured shorts. You could be short on any of these things. Now this is support. It's also the opening swing low. What happens at the opening swing low? Well, I don't know if anybody was getting long, maybe short covering, but if somebody did get long thinking this was a bargain, if we break under the opening swing, that also sets up another short if it's vetted, and I have a location. By the way, location is location, location, location. First, I'm not sure what you're referring to. The shorts were off the table quite a while ago when it hit the primary target. So this is resistance. So all these are additional shorts. You can work these if it's in your plan. Up to you. If not, there's nothing to do here. Now there's several different ways to do this. Well, these are alignment trades with the dominant side, but there's also another condition that we can have. So if the dominant side is down at this time, and this is 8:40, 10 minutes after the RTH open. Now here's a lot of liquidity. So when you're looking at this, there's a few different things you can do. Right here, you have all this resting liquidity. So part of, at least one second, let me look at something here. I had a little trouble with VWAPs this morning because of the time change. This is support or liquidity, so there's buyers laying out here. So for me, when it's coming down, this is a target. So I come down here, this is a scale. Now I have another target over here, CLVN, which is at 46.25. Now I have no idea. Here's the 46.25. So that's the outside edge of this distribution. Think of it like this. It's on sale, retail, and it's too high. So what you see is these outside edges. And this is a higher time frame. So basically the way this tends to work is it tends to go, I'm not paying that. Yeah, but it's on sale. Now this is very high time frame. And then we have 67.29, which is pretty darn important here. And we also have, of course, up here. So these are important levels. So for me, the primary trade, don't forget, was short, and then we have this and whatever, So at that point, so anyway, this trade here, fine. Now, there's still more. Let's see what else there is. So we have this. This now is VPOC migration. This now is the fair price. Everything above us is too high. Let's watch. Now, as soon as you cross over developing volume point of control, it sets up a different condition. Let's look at the difference. RTH open. You notice that when we're migrating up and the market's moving with it. When we cross over, then this becomes resistance. It goes down. It's still resistance. And you'll notice we never crossed over it. Now this is too high. This is where the high volume is. It's right here. And remember how this works. The way this works is it's a shopping experience. So right here, so this is support, and this is the alignment. Now there's no precision in any of this. Also, you should know that overnight VPOC, our volume point of control, which is the highest volume from the last auction, has about an 80% probability. So this is a viable target for extension. So in other words, 80% probability to go here. And I'm also aware of this. So I have a low volume area here, and I have high volume from the ETH, or the fair price. What we don't know is it too high, too low? What the heck is it? This, by the way, this 97, I got to show this to you. This is something I forgot to show you. Just want to show you something. And I'll come right back to this. This 97. Let's go back before today starts. We have to come back. 97.75 was the fair price from here. And that's called a naked volume point of control. It was not tested. Here's what happens. In the ETH high is here. And let's remember how shopping works. If this price is too high, then I can go south. ETH high tested that price. That sets up the short scenario, primary anyway, for me. So I look at that and I go, well, what do I have? Too high, that means too high, so shorts. Then what? Overnight volume point of control, fair price. What's my probability? My probability is to get to the ETH low. Whoop. Statistically, and the overnight volume point of control. So that's at least the orientation coming in, notwithstanding this. Okay, so that is what puts me on the short side, because for me in the ETH, I already found what too high is. So anyway, that sets up all the shorts. Now let's look at change. Now we're in downtrend here. It's just shorts. This is not to be ignored. It's a very important level. This is where our buyers might show up. And here's our icebergs. We can see our buyers absorbing. Now the fact that buyers are here doesn't mean that it won't go lower. There's no way to know. So all you can do is align with it, which is what I do. I've been fooled too many times, so I just don't worry about it. Now here I get a sweep. This is a suggestion of a counter rotation. I talk about this quite a bit in TraderLab. This is a sweep, and what it suggests maybe is that we're taking some inventory out here, and I can anticipate a counter rotation. So right here, if I get above this here, so if I'm short and trailing, if I come above any of this, I'm out. Okay, on a trailing stop. But I've already had a great day already. Now, the condition changes right here. And I posted this in TraderLab right here. So this sets up a condition called mean reversion. This is the mean. So and this is a change. So we've been directional and now we're going to balance. If we balance, this sets up rotational trading. So outside in trading, it's called mean reversion. So when we come outside, the idea, and what's hard about mean reversion is where's the outside, So we have liquidity here, and we have an outside edge. So if we come out here, we can come here. Now, if you don't have a entry here, you don't have a trade. It's easy as that. That's all there is to this. And this, you may not be able to do this. So you might not take this trade. I mean, you might not have a trigger for it, you see. So the idea of this is to come there and to come there. So these are reversion trades. All you're trying to do is come back here and then looking for continuation to fall out the bottom and go to the overnight volume point of control. All these are still shorts. There are no longs. For me, I'm not saying what anybody else should do. It's your business. So now we have our CLVN. We have the overnight mid. The overnight mid has about a 68% probability. And now we get a sweep again. Now right here, let's take a look at this. So the way I kind of do this is I look behavior with different elements. So let's just see what happens here. So this is support. These are reversion trades. This tells you counter rotation, doesn't tell you anything else. Subject to your plan, you're either flat here or you're taking these if you have a trade here, and the goal will be to come here and then continue down, like maybe to here. So let's look. Here, no, let's look at the changes. So here, this is support, break low, come up, still on a reversion here. You can't initiate here. You need to be initiating out here if you're going to do reversion. And the idea of reversion is to come there, 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 and then potentially you need to get under this. You'll notice we're checking it. If you can't get under this, then you can potentially get squeezed. Now let's come back to our variable. Let me come back to our levels. So this is resistance. This is reversion. This would be a rough setup, I think. Let's look at it. This is workable, but you would really need to be already. The hard thing here, now let's talk about what's tough about this. If this is the fair price, what this is doing is it's rotational. So this is reversion trading. These are shorts reversion. And the only way this will go down, not the only way, but the key is it has to get below here. Okay. Now this may not be anybody's trade. It is mean reversion. If it's not your trade, you just don't have a trade here. But let's come back to what we know. We know this is a key location. We broke above it here. It becomes support. If I come outside, and I can't tell you whether or not this is a trade anybody ought to do, that's up to you. I don't really have anything here, but the behavior is reversion to come there. And then the idea is to go. The next one is overnight mid, more resting liquidity, up to you. Let's look again. So let's look what's here. This now is resistance. This is support. Break high. If I get below it, it still can set up a short. If it takes it out, then that trade's over. So here, in here, and you have to be aware. Now you'd be going for this 80%. So if you, and again, this not so much. So in here, you've got your resistance right here. So if you take this, you would be scaled and you get taken out here. Now we're going to come back up to another location. We get a sweep. So right here, we have to watch because we're coming to an outside edge to see if we revert. If we don't revert over here, then that would be the end of it. Let's see what it does here. This is another short. There's your sweep, there's your trigger. These are continuation trades, and you're trying to come here. So all these are shorts for me in alignment with the dominant time frame. Now here, what happens here? Too low. So the key to this trade is here to there, and then again, potentially going out the bottom, if that's your plan. Now, once you're back above all this, then that's that. Okay, so this was the last short. Because once you start coming outside, and you'll notice where we are rejecting this now. So we found too low. This was the last short. So after that, there's no more shorts unless you are going to just trade from further outside. And then we have the possibility always of filling the gap. Let's go look. By the way, filling the gap, so you guys know, has about a getting to the previous high or low has about a 68% probability. So to fill the gap's about 68%. And then at 9:30 Central Time, which is here, we have the first hour's high or low that has about a 98% probability. So once we come up out here, so anyway, the shorts are over in here. So now the thing becomes, are you done for the day? For me, if I'm trading that side, I could be done for the day. I have no problem with that. If somebody wants to turn around, then the trade would be the IB continuation trade, and you have the VHVN, which was resistance, becomes support. Another way to do it. And you have this, and since we didn't get the ETH low, we have this, and then we have the gap. Again, subject to your plan. Or you're done. Doesn't matter. So this is support. There's a sweep. You could be long against here. You're going to try to go to there. The other piece is at 9:30, we have the IB high, which has statistically over 98% probability to take out first hour's high or low. So you could be, if you get long over here, you're going for that, which is this high, because there's buy stops here. And then sweep, you could be here, you could be here, here, here are longs. You're going there, and then the gap. Or you're done. Either one. Here. And resting liquidity. Trade could be done here. So you would have a long from here to the gap. And this is very structured. And then the liquidity, and then this trade could be done here. That's that. So it would be primarily shorts. When we come out of mean reversion, now we get directional going the other way. There'd be no more shorts. Then there would only be longs. Subject to your plan, there would be no longs until you come back over these structures, and then you'd be going for the gap fill because you have this high and you have the distance to the gap, and you know the shorts have buy stops in here. That's about it for me. Those are the trades I would take, or I should say that I would suggest for developing traders, because it's very organized, very process driven, and if you had the patience and you can define the conditions, you would be waiting for the trades, and when the trade shows up, you show up. If the trade doesn't show up, you don't show up. VPOC migration. So now this is the new retail price. That is saying what's below us at the moment is too low. And now we're inside yesterday's range. So for me, I could just sit back. I have nothing to do. This is a potential target, not a recommendation. We have to watch what happens here. We know we have buyers here. I'm going to throw a little something over here so we have it. It's the ETH high. Now these are order flow triggers. Not going to get into them too much today. But you see how this comes in over here and where it is? ETH high. So when I break above this here, if I'm looking at this, if I buy this, my stop is not going there. my stop has to be further outside. This is one of the things where we are risk adverse. But the thing we need to always remember is where do retail traders put their stops? At the closest place they can because they're risk adverse. What I kind of think about is, you see this here? These sellers, why did the market go up? Because there's buyers here. Well, if I know there's a buyer here, I'm also going to know there's a stop there. If we come down and there's these sell stops coming out, if the market is going to go higher, I already know that we might, underline, find the buyers that were here come back in here. Oh, really? And there you go. You see? And then when we pull back, I get the sweep. The sweep suggests rotation up. And what comes back in? This. The order flow shows me the buyers are here. There's the limit orders. That's the icebergs. Those are the stops. Where am I putting my stop? Am I putting it there? No. Why? Same reason. Sell stops are under here. You get stopped to the tick. What do I want to do? I want to be a buyer, but where's my stop going? Under here. You see? So when you start vetting, you got to be thinking about, and I would say, think like a retail trader. Don't act like one. It's not more complicated than that. Your impulses are driven by your fear of loss. So at this point, we have our liquidity here where our sellers were. This still looks like we may rotate in here. Now here's your choices. What's the higher time frame? Is it up or down? Isn't it interesting? So in your time frame, what is the condition of the market? Did we just squeeze the shorts out? Fill the gap? Take out the weak side? Remember, we were out of balance. Inventory was short. Remember how the market works. It rotates over itself. The market goes up to go down and goes down to go up. What do we do this morning? Gap lower. Down. What do we do in the ETH? Down. So the market's short. If the market gets short and we get continuation sellers and we run out of sellers, what happens? The short's covered. Those are your buyers. Now, the thing you don't know at this point is how far up the food chain might we go to squeeze? Unknown. So here we are. There's our outside edge. This is where the ETH high was. It was too high. That sets up our shorts. We now have too low, and it either sets up longs or you're done, whatever you're doing in your time frame. So what we know is value area low is here. 42 is a potential target. We also know 29.5. So we have 42, 29.5 on the upside. There are no shorts for me other than if I take a short, I have to find, if I take a short, it's going to be very nimble, So primarily the structured trades, which are the trades that developing traders can reverse engineer because they show up often. So you're going to get a lot of samples. You would have the IBC, which is the long out of here. And once you're above here, you're going to fill the gap, and then the next layers are up in here, and we'll see what it does. Not a recommendation. Let's come back. Remember, if we're down, if we're under here, it's still, for me at least, other than trading rotations, the trend is down. Doesn't mean I won't take longs. It just means the primary trades were the shorts, and then we have some continuation longs. That's all you need to do, in my opinion, to build out a business process and create sustainability and maybe profitability. And that's just why this is what I share in TraderLab. The idea of Trader Lab, remember, is that you learn how the market works, why it does what it does, and build out structured trades that you can vet so that you only interact with the other participants when you have a statistical edge. That means that it favors you versus them. The outcome is going to be random in spite of it all. So your job as a trader, and I hope you understand what the job of trading really is, it's just sampling the market for your edge. If you have an edge, then when that trade shows up, your job's to take the trade. You're going to be fearful because it's uncertain. Think about how a casino works. The dealer only controls how they play the game. They don't, but they have to play the game to get the edge extracted. So it's this random distribution of outcomes, and psychologically we're extremely uncomfortable with uncertainty because we're wired to seek certainty for a lot of reasons. And there's, by the way, a lot of books available and a lot of information in Trader Lab that you guys can research so you can understand the mechanics psychologically and the obstacles this presents. Remember, this is not a video game. Your job is to take trades that have edge. If you don't have a vetted trade, you just sit and wait. It's like a bus. You just wait. First, you're saying the trend is up from the ETH. Does that mean if you were taking shorts that you were trading counter trend short? Then you should only been taking longs. So I think that's about it, guys. We have covered what is, and the current situation is longs. I don't have any shorts, and it's just either continuation longs at the moment or nothing. Doesn't matter. So how are you guys doing? Conscious? Okay. Would we still not be trading mean reversion from Friday's low? Friday's low, I can't say what you would be doing. What does Friday's low have to do with mean reversion? You mean short? I'm not sure what you're asking me. No, I'm not. I have no shorts. For me, the short trade's over. It's only longs or nothing. You know, doesn't really matter. This is the next area we're looking at up here. So we need to watch these areas up here. This is an outside edge. It's right around the value area low. It's this 40, this. So this is a target to observe, not a recommendation. It's just a level. And remember what happened down here. We down near the low of the day was an outside edge. If we come around, this is an outside edge, and then we have value area low. We can, in theory, even come back here. Not a recommendation, doesn't have to, not really material. So we'll see what it does. So if you're trading longs, you just manage your trades. But shorts for me are not on the table other than trading rotations, which is time frame. Let me get this back here. Time frame specific. And if you're not proficient as you go down in time frame, you really want to try to stay with the broader stroke for your risk. Because as developing traders, you're going to take more stops because you're going to be less disciplined, more FOMO, poor locations. That's just normal for developing traders. You're just going to experience that. So the way you cover stops is range. This is not where, We're not trading for this. We're trading for that, you see. So when you are operating, it's really about range. Anyway, and there's no precision in this thing, you know. One of the things to think about in your time frame, this is something you have to carve out. What is your time frame? If this is the fair price and we are directional, what is the possibility of going from directional to rotational? It's possible we come here. And it's hard, only in hindsight are you going to know. But I use order flow, and let me show you this. Now, I don't pick the high of anything. It's just I'm no good at it. I don't do it. Never been able to. I don't put my energy there. You know, the high and the low are always clear in hindsight, so I don't bother with that. But let's look. This is resistance, breakthrough. This becomes support. This is resistance, breakthrough. This becomes support. This comes in, breakthrough. This sets up potential resistance because I'm under this. This is an order flow trigger. Your stop will go here and you'd be trying to go there. Now this is like picking, it is the high of the day. This is a very aggressive trade. And the idea is to come there. This is not for developing traders. You have to vet this. Now when I think of the high of the day, I'm not really thinking about the high. I'm thinking, I know I have this. So this becomes an extremely aggressive trade. And it may not be your thing, you know. You have to be pretty experienced. And there's enough range, you see, to make it worthwhile for the risk. But if you got short, you'd be looking here at this liquidity and here. So you got like resistance and support. When you break under here, if you sell it here, your stop's got to be really out here or out there, and then you're going to try to go to this. But again, it might not be appropriate for you. This is also here. Let's just look at this a little bit. These are not trades. These are just ideas. Okay. The idea, what I found is this is language, and what my job is to try to read what's going on, and it's a language of pricing and volume. If this is too high, I've got my sellers. There's my absorption. My buyers are here. They're absorbed. So this is too high. So if I sell this here, I'm going to take a stop. I'm not trying to pick the high of the day. Remember? So if I come up here, this is resistance. I break high. There's the next resistance. What happens here? I break under it. This suggests counter rotation. Where else is my resistance? It's right here. Now, I am not selling it unless I'm, again, time frame oriented. So this is resistance. This is retail. So the possibility is to come back here. If it doesn't do it, then that's that. That's part of the randomness. These are not trades that anybody ought to take. What the idea is that you learn to interpret what you see, not what will happen. That doesn't exist. So you have to interpret what you see. So this is your area of resistance. Let's see what it does. You guys have questions? How are we doing in YouTube? Let's take a look. Gotta lose the chats. I got them back. Your charts were incorrect? Well, it's kind of important. The open was confusing because you felt like we were going to fill the gap. Okay, Greg, here's a question for you. What does your feelings have to do with having a process and a plan? When you feel something, right there, you've got to stop and ask, what am I feeling? And see, here's the question, and this is not for you, this is for everybody. If I feel and I don't take shorts, and I feel the market's going to fill the gap, then here's the question becomes, where's this feeling? Is it a fear? So I don't take shorts, when they show up. The feeling is the key word. We must be conscious of the things that are influencing us. Um, and it's really important to differentiate between what you feel, which is uncertainty, of course, and what you do. So the plan is to supersede any feelings you have. This is why we have plans, because otherwise we're always going to feel uncertainty. We're always going to be fearful. We're always going to look for confirmation, and we're going to be out of alignment. And then we're going to be subject to FOMO when it runs away from us because we're feeling something which has nothing to do with what the market does. Our feelings don't mean anything here. Our feelings are primarily generated by fight and flight and the rest of that, you know? So, kiloton, you're trying to catch the buyers being exhausted. Oh, you mean you're picking the high? Well, that's a recipe, kiloton, to put yourself out of business. So I would suggest you kind of get a grip because we've had this conversation many times. So there's still nothing here to do. Trend is up, condition is up. Anything you do up here on the short side is counter trend. Probabilities aren't with you. And in hindsight, we will find the high. Remember this. Has a statistical probability as well as that. So, nothing to do. Just unless you are a short-term rotational trader with an edge. So kiloton, rinse, repeat. Any questions, guys? How we doing? So, Greg, I hope you got that. The thing that's confusing is uncertainty. Um, so, we're going to be uncertain. Now, confused is a different thing. Confusion comes from not having a defined plan. So, and it's not that the plan is right, wrong on one trade. It's that all these elements need to be defined. So when you then come into market, you already know what might happen, not what will happen. And then as soon as you determine it based on your plan, in other words, the condition of the market, and you see the behavior that you're anticipating, wherever it shows up, then the trades that have been vetted that have an edge under that condition are deployed. And then the outcome. Yeah, Matt, go to linsoft.com. That's all been discussed in the stream already. Not in the stream, but in the chat over the weekend and onward. So scroll back. Okay, let's watch behavior here. So we had sellers here, sellers here. Let's watch. Now remember, there's no shorts here. Okay. Okay, you can see here we have some high volume, which is where we found sellers. Uh, Watch the order flow. They are pulling. You'll notice how it gets lighter. These are just algos. There is no shorts. So those of you who are trying to fade this, I can't imagine why you would do it. Sounds like FOMO to me, and you're off sides. So if you're fading, why? There is no such thing as house money, kiloton. I suggest you learn a little bit more about yourself and the way you are rationalizing your behavior, because there is no house money. That is not a winning mental condition. House money is a word that gamblers use, not professionals. So, time to become a professional and stop gambling. Those habits of gambling, that's a choice you make to put yourself out of business. So, that's, of course, up to you. But I think you know what I'm talking about. This is a business of discipline. As soon as you get overconfident because you've had a couple winners, you now are sowing the habits that are going to take you out of the business. So you need to understand that. If you don't understand it, then you can do whatever you want, remember. But I've seen so many developing traders that they could have your name because their behavior was, past tense, the same as yours. Think about it. Kiloton, there was a good book that we were talking about in the Trader Lab, which I don't remember which one it was. Best Loser Wins, maybe. There's a couple other ones in here too. The one that talks about, I don't know. Somebody else can, can't remember. But there's some really good books, and you should check out some of Greeny's posts in Trader Lab. There's that one on the psychology, which is really a great book, and there's some others that talk about gambling and what happens when you get confident. It's all the lunatic under the hood, Kiloton. So you got to get a leash on that other aspect of yourself, Hyde, the maniac, who's going to take you out of the business. You need to recognize your response and stop. It's like wake up, smell the coffee, because that's very typical retail trader behavior. And we know 95% of those guys fail for a lot of reasons, but that is definitely one of them. So, up to you. So, higher time frame, value area low is the next area, and possibly back here. Remember, what is important is this level all the way back here. So we'll see. So what do we have? Let's talk about what we have. We had sellers in here, gap lower on Friday, filled the gap. That's as best as they got, and we took the longs out that had their stops here. This is really a nice trade on Friday. Today we get the gap, we come down, and now we are coming across, we are squeezing the early sellers, and now we have the sellers in here, and we could go anywhere, of course, but this is basically an inventory rebalance here, as I see it, because for me the trend is down. Now it doesn't mean I don't take longs. because it's different time frames. But in a higher time frame, trends down. Unless, we can come back in here. Then for me, this is very important. And what makes it so important is this is where the buyers were, you see, here. So as long as I'm under here, then this could do whatever it wants to do. If it changes, I change. Doesn't matter. This is not a business of right wrong. This is a business of alignment. Everybody, I hope you can remember that. Um, anyway, so we're looking over here. So let's see what we got here. Let me look at this. Yeah. Yeah, I don't really see where there would be some really well structured continuation longs. Uh, I can see structure, but I don't see the way that traders could do it without taking outsized risk. Yeah, this is not going to work. Yeah, this did come back. And down here, yesterday's low, there was just nothing here to work with, for me at least, structurally. So, nothing to do. Still nothing to do. Yeah, Kellison, thinking fast and slow. I think that's the difference. You responded to the thinking fast. You were not intentional. So, you know, very important to differentiate. When I read that, I was thinking about thinking fast is hide. Thinking slow is process and discipline. So when I was reading that, thinking fast, thinking slow, the thinking fast is the impulse, you see? So that's kind of interesting, isn't it? Let's watch this right here. Microstructure. It's not a short, it's just behavior. Let's take a look at it. So in the microstructure, and this is not a short, I'm just showing you behavior. What you're looking at right here is potential micro counter rotation. Right here. You have liquidity, you have this, and you have the trigger, you have a retracement. It is not a short. It is all we're talking about here is market mechanics. So let's think about this. What is this? Let's put a few pieces together. Just structure, nothing more. Just some ideas. This is an outside edge. This is called the low volume node. This, if this pulls back here, it can come back here. So this can come from out here back to there, or from here back to there. They're not trades, they're structures. So we want to learn to read the language of the market. So support, resistance, watch, support, resistance. Let's just see behavior. If we think the trend is up, there are no shorts. This can be trade management here. If I don't get above this, then I got that. Let's see what it does. microstructure, high volume, break low, trigger, test. Now we have the other side over here and we have stops under here. So what we want to look at now is out here to observe. So we have now some reference points. We've got this and there's stops here. So the idea of this would be possibly to come out and pick these guys. And then we want to watch if these guys here, what happens here. So this is the next area to observe. So anticipate is there are buyers here. So if I come under here, are these buyers going to still be here? Now, I don't suggest anybody trade this stuff, okay? I'm just suggesting that you learn how to read the market. So this is an outside edge. So, and these are not longs for me. These are nothing more than structure. I will not trade this range for me, and it doesn't matter. Uh, but my trading is a lot different than a lot of you guys. I trade large rotations. So I don't, you know. So once it changes for me, um, and I won't know that until, based on what I define as context changes, then I just wait for continuation to a line going the other way. But I don't trade the counter trend side. I wait until the process has changed as in my time frame. And that's very different than a lot of other traders' time frames. So I found, in fact, I'm trying to think, was it Best Loser Wins? I don't remember who talks about the R multiples. I don't remember which book. And maybe in the Thinking Fast and Slow, might be in that one too. It talks about trading range versus action and bailing out because of fear, that kind of thing. So those are good books. I suggest everybody, come to Trader Lab. If there's a lot of resources in Trader Lab, a lot of great reading material, some of the best books ever put together on trading. Um, I mean, there's so much stuff out there. Actually, years ago, I worked with a guy who we all faded. In other words, whatever he did, they actually would call me from the floor to ask me what he was doing. He was very reliable. He was a consistent loser. Um, I'm not mentioning names, but you can still buy his book. It's still on Amazon, and it was a bestseller. That's all I can tell you. So you got to know what you're looking at, and you have to vet everything. It's very important. So anybody can write a book. Anybody can do anything, right? So that's why when you build a trade plan, you actually have to build it for yourself. Take the information you gather and glean, eliminate the noise, but you have to prove everything because what one trader does and what you do don't have to be the same. It's not rigid. It has to align with you psychologically. Time frame must align. But you will find most traders who are in the business for any length of time are not trading short rotations because you have to try to catch larger swings to pay for the stops you will take as you probe for location. Are you asking me, Fox Feather, about gap and go or gap fill? Well, it's starts out one way, and then when it changes, you know, it changed. So it doesn't stay fixed because the market is continually auctioning or rotational. But at times it's directional, and then it changes from a direction to a rotation, and then it'll balance. So what we had this morning was down, and then what's called mean reversion, continuation rotational trades. So we had down and then outside in, outside in, outside in until it breaks away from that structure. Then the shorts are over, and that's it. Then if we turn around and we have long structured trades, we can take those. And then you would be going for the gap fill and value area and all this. All this is the targeting up here. And maybe higher, doesn't matter. So there are no shorts for me. When I look at something like this, it doesn't say short. It says counter rotation. That's not a short. It becomes a trade management opportunity if I am long, this is how I suggest traders develop an understanding of this. And that is, if you're only on longs now, how do you recognize counter rotations? It starts with trade management. You see? So if you're only trading longs, this is an exit. It's not a short. And then you're done with the longs, the structured longs, or you have other trades. It's just a matter of what your trades are. So if you don't, like here, you don't have anything here, there's nothing to do. What? Why? What was here? Remember this? This is resistance. Break above it. What does it become? Support. Support. No trades here, by the way. Resistance is here. No trades unless you can trade this. And you know why and where. And if it's just rotations and noise and you have no plan for it, it's not your trade. There's just nothing here unless, again, it's your trade. It's very important that this is like waiting for buses. You wait for the bus and then you wait for your trade. When your trade shows up, you need to have the courage to put it on. Where do you get courage from? It's from edge. And where does edge come from? Statistics. If you don't know where your edge is, then you're gambling. And you're going to have winning trades too. That's the fallacy of gambling, kiloton. And that is training yourself to be undisciplined. And you're training yourself to potentially fail. I don't think that's a good plan, do you? Nancy, are you in the Trader Lab? Nancy, if you come to Trader Lab, there's a library of webinars and PDFs and a lot more on things that you can do. But the idea of the Trader Lab, and there's a link in the bottom of YouTube, it's open to everybody. There's no cost for it. The idea, notice what we have here, location. Let's see what it does here. These are not trades. These are just levels. So again, I don't have any trades. I just sit here and I don't do anything. Sit here and go, oh, that's nice. Please give a like if you're visiting in YouTube. Appreciate you stopping by the Trader Lab today. Remember, this is about the business of trading. Don't forget there's 60 PDFs of structured trades you can download. There's no cost for them. There is no plug and play, but it does show you some of the trades I talk about in the lab. Some are real time, others are just screenshots with some explanations, but there is no plug and play. You have to vet each one of these and learn why they might work at certain times under certain conditions and why they wouldn't work when it looks similar, but the condition's different. So anyway, Those are available. Please give a like. Here's order flow phenomena and a lot more. Please give a like if you're visiting in YouTube. Subscribe to the channel if you want to get notifications of other educational content that might help you. Visit the Trader Lab community. All you have to do is confirm your Discord username so we make sure you're not a spam-a-later. And this is not Romper Room. It is about the business of trading. So if you're interested in that, you might want to visit the Trader Lab. There is no cost. Thanks again, guys. Don't forget to like. Look forward to seeing you soon. And thanks so much today for visiting the Trader Lab. Appreciate your time and interest.